Government issuers. Here we're going to look at how to do credit analysis for fixed income instruments issued by governments, so sovereign, and then by their agencies or their states. So they are still backed by the government, but we call them non-sovereign because it's not issued by the federal government, but by an agency backed by the government or by a state within that country. So why do we need a special approach for this? Because of course, a government is not a company. For corporate bonds, a different type of analysis is required. You get into the default risk and all the things that we discussed with respect to the spread for credit risk. But when we talk about governments, sovereigns, and other public issuers, then we need to have a different approach to evaluating this credit worthiness. So how does one go about doing it? Before we get into the credit analysis, let's have a look at why do they need to borrow money. So there is something known as a fiscal deficit, right? And what is that? That is a government spending more money than it is raising in tax. So on one side, they have their tax revenue, and if that tax revenue plus other fees and stuff, right? So that is their source of revenue. And then they'll have their government spending. So usually what happens is for countries, the government spending is more than the tax revenue. And the difference is called the fiscal deficit, which is then financed by loans. And that's where these bonds come in that are backed by sovereigns, or even if they're backed by the government, but not directly by the sovereign, but through their agency or some state, they will be used to bridge this gap between the revenue and the spending. Now, the question is, if they are spending more than they are being able to raise, then how will they repay back the lender? And that's where the problem comes in, because the same source, which is your tax revenue and other fees, is what is going to be used to repay. So it's kind of a catch-22 situation that already clearly that source is not enough because your government spending is more than what you're being able to get in terms of your revenues. So if that stays the situation forever, that your revenues are always less than your spending, then you will never be able to come out of this problem. And that is what we see in a lot of countries. I mean, if you are following the US debt issue, what happens is every year almost they are coming back to the Congress and saying, oh, we need to raise the debt ceiling because the US Congress has placed a limit on how much loan the US government can take with respect to its GDP. And that is a quantitative ratio we'll look at shortly. But then the lawmakers have to again change the law and say, okay, you can borrow more. But this has to end. And where does it end? So that's where all this analysis comes in, that we look into what's happening under the hood of a country, right? I mean, are they growing? Is their tax revenue growing? What's happening with their spending? So all this type of analysis has to be done before you want to lend to a government. And not all governments are same. So we need to look at different governments with respect to different aspects. Now, primarily, the base is your tax, right? Because that is what is going to be used to repay the lender. And what we like to see is a diversified economy. So when we say advanced economies, right, what that means is that they are diversified, first of all. Right? You have your emerging and frontier markets, and what we see in a lot of these cases that they have a lot of concentration in one area, right? So maybe you have an economy that is very focused on oil, or you might have an economy that is very focused on textile or something or the other, maybe copper. So we have these countries which are relatively not that bad, they're decent economies, but it's just that they have a lot of concentration in one particular sector. So that's risky, right? But your advanced economies which are diversified will be relatively default free. And this is not just so simple. There is, of course, other factors that we need to consider. But at a high level, I mean, I just want to help you develop your mental map that what we're looking at is you can think of it in terms of a continuum where on this extreme we have completely diversified mature economies, right? And they will be considered default free. And then we have very weak economies. And then somewhere in the middle, we have these good economies, but they are focused on or concentrated in one particular type of activity. So the risk obviously is going to increase as we go towards the left and almost becomes zero as we go towards the right. Right, so how do you do this analysis, right? How do you go about quantifying it? And why I'm using the word quantifying it, because even though we will be using a combination of qualitative as well as quantitative factors, but even this qualitative stuff, we need to quantify this, right? You can't base something like credit analysis on just a subjective discussion, oh, that this country has a nice government. Now, what does that mean? I mean, how would you rate it on a scale? So we do actually quantify even the qualitative factors. And let me give you an example, right? So usually the ability to repay a loan is going to be very quantitative anyways, right? In terms of what is their tax revenue, how much of a loan have they taken with respect to their tax revenue, can they easily pay it back or not? So that is stuff you can put in numbers and calculate ratios, and we will look at those ratios shortly. But with respect to the willingness, again, that is a subjective point, right? It is a quantitative point, that are the politicians in that country nice? Are they good people? Are they going to stand by their promises? So this has to be something which needs to be quantified, right, before we can take a decision in terms of whether we want to lend to this particular country, right? So if they're good people, then how good are they on a scale of 1:5? So that needs to be quantified. So anyways, let's get into the qualitative factors first and see how we can quantify some of them. And then we will get into the actual quantitative factors, which of course are 100% quantitative. Now, what are all the qualitative factors? Of course, we're going to discuss each of these separately. But before I jump into all of them, let me just give you a high-level overview. The first one, which is government institutions and policy, this is related to consistency. What we want to see is that there is a certain amount of consistency in the government. There is rule of law, right? There is democracy, so that we feel that the country is having a solid foundation. They have an appreciation for human rights and rule of law, and there is a certain consistency in their political system. Then we move on to more quantitative factors, which is still coming within qualitative, but of course this is more and more quantitative as we get into it. That what is their fiscal flexibility, right? In terms of how much revenue they're generating, what is their tax base, and are they able to afford the type of loans that they are taking. And then of course this will be revisited when we get into the quantitative factors. Monetary effectiveness, this is related to the autonomy of central bank. And in a lot of countries, what we have seen is that the politicians, they really influence the central bank a lot, and they force them to print money and make it available for the government to spend, which is very bad because that's inflationary, right? When your government is going to print money and give it, when your central bank is going to print money and give it to your government to spend, well, then literally it's just pumping money into the system without a check and balance, which will definitely lead to very high inflation. So that's not good. That's not good. And therefore, the central bank should be independent or autonomous. And therefore, it will help in making sure the monetary policy is effective. And I think this point is very valid, especially if you're lending to a country in a different currency. So let's say you are a US investor and you are lending to a country, let's call it country ABC, and this country is borrowing from you dollars and it is going to pay you back dollars. But then what's happening in this own currency is that they are printing their own money, let's say ABC dollars, a lot, right? So that means if the inflation in ABC dollars is, let's say, 40% and inflation in US dollars is only 4%, so there's going to be a huge devaluation that will result. And then this country will not be able to use their ABC dollars to buy US dollars to pay you back, right? Which means they will default on your loan. So this is something that we really need to be very, very careful of, that if we are lending to a country and we're lending in a currency which is different from their local currency, then they'll definitely have a difficult time paying us back if their central bank is not autonomous. Anyways, I know you might be feeling a little bit confused because these are high level little complicated concepts, but what we will do is that, of course, we're going to go into each one of these and discuss more, right? But let me again continue with the high level overview before we jump in. So now, coming to economic flexibility, here again, diversity of economy, right? Again, we don't like concentrated economies. We want diverse economies with a lot of different sectors and industries, right? And external status is, how is their relationship with other countries? How is their relationship with IMF? What is their current account status? Are they exporting more than they are importing? Obviously, we would like a country which has a positive current account surplus. It has a surplus. So now let us start jumping into each one of those. So starting with the government institutions and policies, here I said what we like to see is consistency, rule of law, appreciation for human rights, right? So do sovereign government institutions and policies foster political and economic stability, right? Which will only come with consistency in policies and an appreciation for rule of law and democracy and human rights. So are the basic legal protections in place, such as maintaining rule of law, enforcing property rights, promoting a culture of debt repayment? That do the leading politicians stand by their word, right? And this is really, really important because, there's sovereign independence that they have. So it's not like a company which you can take to the court and make them bankrupt and then force them to sell their assets. If the politicians decide not to pay back, well, that's their decision and they can do that. Of course, everybody else will then maybe not lend to them again, but the money that they've already lent to them is something that will be gone for the time being. So this, of course, needs to be seen in a quantified manner, because coming back to this previous slide, that culture, promoting a culture of debt repayment, I mean, that's such a subjective point, right? But what we need to do is we need to convert it to some sort of a ranking or scoring approach where we want to see how can we choose between countries that have more of a propensity and they're inclined towards repaying on time versus those who might have some malintentions. So we want to see stability, we want to see a desire, a willingness to repay on time. We want to see nice relationships with neighbors, right? We don't like conflicts because conflicts mean that there could be potential default if things go sour between these countries. Right? So what are we talking about over here? We're talking about their ability and willingness. So this willingness is where the subjective factors are really coming in, which needs to be quantified, right? And as far as ability is concerned, as you will see in the quantitative factors, that it is easily quantified, right? There are a lot of ratios that are there that help us manage the analysis with respect to ability to repay. But the willingness is a bit more trickier, and that needs to be consciously quantified, ranked. And why is this so important? Because of the principle of sovereign immunity, right? You cannot force them. Or, I mean, it's really hard for you. There's serious limitations on the investor's ability to force them to declare bankruptcy to liquidate its asset to settle claims. Right, now moving to fiscal flexibility, which is more related to the ability of them to pay back. And what we want to see is how good a ship or how tight a ship are they running, right? I mean, are they sort of living within their means? What is their tax revenue? How much are they spending? Is tax revenue even collected properly or not, right? Are they just throwing money to public expenditures? Is there a lot of kickbacks? Is there a lot of corruption? Or actually they have good parsimonious spending going on? So that is what needs to be analyzed, right? Is especially the trend. I think what you should also look at very importantly is the trend, that even though, okay, maybe the debt is a certain percentage of the GDP, but is that good or bad? Like, is 50% good or is 100% good? So in some cases, I would say 100% of debt to GDP, even though it's huge, is very high, but I would say still it's okay because maybe the trend is downwards, right? And then 50% I would say maybe is not good because maybe the trend is upwards. Or depending on other factors, that whether they can afford 100% or 50%. So every case to case is different. So it's not just that you see a number and then you say, okay, this is good or bad. It's you have to see it in the context. You have to look at the trend. You have to see, okay, what is this company's economy like? Is it diverse enough, right? Are they able to collect tax from their people? A lot of countries we see is that they have such huge black market economies that it's just very hard to collect tax from them. So these issues are there. They're very real issues. Right, now moving on to the monetary effectiveness. So again, this I would really like to emphasize on the importance of autonomy of the central bank, right? Because in a lot of developing countries or frontier markets, what happens is that the federal government, the politicians, they start using the central bank as their money printing machine, which is very bad because it's obviously going to be inflationary, as discussed earlier, right? So what we want to see is that the monetary policy should be independent of political influence, right, as much as possible. We don't want government intervention and influence in this, and so that it can be as effective as possible, right? So central bank independence from public treasury reduces the likelihood that they will monetize its domestic debt, raising domestic inflation and lowering the currency's external value. So again, let me explain this again. Let's say you are a US investor and you are lending to country ABC, right? And you're lending in US dollars. You want your money back in US dollars, right? But these guys, they have ABC dollars. And if they start printing ABC dollars and just using them for corrupt spending, well, then the value of ABC dollars is going to go down. And it will be very hard for this country to then purchase US dollars and pay you back, right? Because let's say if when you paid them the US dollars, it was $1 to one ABC dollar. And then later it's like five ABC dollars to $1. So then how will they be able to buy the US dollars and pay you back? So it makes it very difficult for them. So this is why we don't want any kind of influence of the Ministry of Finance with the central bank, right? We want the central bank to be independent from the public treasury or the Ministry of Finance, which is of course coming under the government, the politicians. Right, now moving on to economic flexibility. Again, what we like to see here is diversification, right? We don't want a concentrated economy in terms of one commodity or one sector. What we like to see is a diverse economy, and ideally with good growth potential as well. So that of course is the ideal situation, right? And we do have such economies. I mean, look at Germany, of course, United States, nothing comes close to the US, and that's not just because of the size of the economy and the diversified nature of it, but also because the US has something nobody else has, which is of course the US dollar, and we'll talk shortly about the importance of that. But first, let me talk more about the diversification of economy. So Germany or China, right, or UK. Well, UK not so much anymore. It's becoming more and more service oriented, but Germany and France are doing pretty well, right? China is doing really well, especially with respect to growth. So the growth is still there, right? India is coming up, so that's interesting. So what we like to see is diversified economies and no focus on a single commodity or industry. Plus, we don't want a sizable informal economy because difficult to tax, right? Black market, informal economy. It's very difficult to tax this sector because it's the visibility is low. So how are you going to tax a sector in which you don't know what's going on? So we don't like that as investors. Now, external status, again, this is related to IMF and how much outstanding debt is there, how much is that of your ability to generate revenue, right? Are you sort of living within your means or not? What's going on with your international trade, capital, right? Do you have a current account surplus or a deficit? If it's a deficit, how bad is it? Do you have a capital account or a financial account surplus or deficit? So, I mean, what's going on in your external accounts? So the key point here is nothing beats the US dollar right now because it is the world's reserve currency, right? And to some extent, of course, the euro is a reserve currency. To some extent, the pound might be a reserve currency. Maybe the yen is starting to position itself. The yuan, RMB, right? So if other people would like to save in your currency, that's good because other countries start putting a portion of their money in your money. That increases the demand for your currency and maybe also increases the demand for your debt. And that has been happening for the US. And that's why, remember when I was saying that what is a good debt to GDP ratio? So a country like the US has maybe a higher debt to GDP ratio than other countries like China or India, right? And we might say, oh, China and India are better than the US because their debt to GDP, right, is lower. But then again, China and India don't have what the US has, which is the world's reserve currency. So this whole context is, I mean, this whole discussion is something you have to see in the context. And I think what's really important is to look at trends, right? So if this trend is up and that trend is down, which it's not, the US trend is still up, but that's not the point. The point is what you need to do is understand the importance of trend analysis when it comes to these factors. So again, coming back to external status, that many emerging and frontier markets have exchange rate restrictions, so they're not open. Their capital markets, their financial systems are not open. It's very hard to get money to come out of those countries, and there are significant capital controls that they are placing versus other countries which are open. So obviously we want them to be open and not restricted. Otherwise, as investors, it is difficult for us to then get our money back. So now this is an exhibit from the curriculum, which is just bringing everything together on one infographic. So that's nice, right? We talked about all of this, starting with the subjective analysis of the government and how much of an inclination it has to respect people's property rights, rule of law, willingness to pay. Of course, this has to be quantified. So you need to rank it, needs to be ranked, right? You have to quantify it. Monetary effectiveness, I think the key point here is the autonomy of the central bank. We don't want the federal government to use it like their personal money printing machine. Otherwise, it will lead to inflation, which will then lead to devaluation of that their local currency versus your currency. So you don't want that, right? You also want to see their fiscal flexibility, right? Discipline in terms of how much expense are they doing versus their revenue. We don't want them to be going overboard. And even if they are going overboard, or to some extent, how are they using the money that they are borrowing? Are they spending it in corrupt projects and with the politicians taking kickbacks, or is it genuine growth oriented spending, which will lead to future increase in tax revenue collection, right? So you want to see what type of policies are there. Then, of course, how good is their economy? Is it diverse or not? Which, of course, reduces their exposure to any kind of concentrated risk, and then increases their adaptability to shocks. And finally, of course, external status. If they have a global currency status, that's very nice, right? Do they have access to external funding like IMF, ADB, which is your Asian Development Bank, and so on, right? And what's going on in terms of their geopolitical scenario. Right. So, of course, what we are saying is that these factors are all interrelated, and a weak legal system will maybe, also reflect in a limited ability to collect taxes and enforce debt contracts, and probably not very good, bad property rights, right? And so on. So it is all, of course, interlinked. Right. Let's take a break here, and then we'll come back and jump into quantitative factors.